Michael Burry doesn't tweet often, but when he does, markets move. The investor who called the 2008 housing collapse, the man Christian Bale played in The Big Short, has spent the last several years quietly building one of the most controversial positions of his career. He's shorting artificial intelligence, not the technology, the valuations, the euphoria, the certainty that this time is different. And if history is any guide, when Michael Burry gets this loud about a bubble, it's worth understanding exactly what he's seeing and which companies sit directly in his crosshairs. This is the Burry AI thesis, broken down. To understand why Burry is short AI, you have to understand how his brain works. Burry isn't a macro trader. He doesn't predict recessions. He looks for one specific thing, mathematical impossibilities dressed up as opportunities. In 2005, he found it in mortgage-backed securities. Wall Street was rating garbage loans as AAA. Burry read the underlying documents, actually read them, and realized the entire housing market was built on paper that could not survive a single quarter of default increases. He was 3 years early, he was mocked, his investors tried to pull their money, then 2008 happened and he made hundreds of millions. In 2020, he found it again in passive index funds. He warned that ETFs were creating price distortions that would eventually snap back. Now he sees the same pattern in AI, companies trading at 50, 80, sometimes over 100 times sales, retail investors piling into every ticker with AI in the pitch deck, capital expenditure projections that assume infinite demand growth, and a small handful of stocks propping up the entire market. Burry has seen this movie before. He knows how it ends. Burry's AI short rests on three arguments. First, capital expenditure is unsustainable. The largest technology companies in the world are spending hundreds of billions of dollars per year on AI infrastructure, chips, data centers, power contracts. That spending is being justified by future revenue that has not materialized. Burry's math is simple. At current burn rates, these companies need to generate trillions in incremental AI revenue over the next decade just to break even on the build-out. He doesn't believe the demand exists. Second, circular financing is inflating the ecosystem. Chip makers invest in AI startups. Those startups then use the money to buy more chips. Cloud providers extend credit lines to AI companies that then spend that credit on cloud compute. Money is moving in circles, creating the appearance of demand where real end-user revenue is thin. Burry has flagged this pattern publicly. He compares it to the vendor financing schemes that inflated the dot-com bubble in the late 1990s, when Cisco and Nortel loaned money to customers so those customers could buy their equipment. That ended badly. Third, concentration risk is at historic extremes. A small number of stocks now drive an outsized share of major index performance. If sentiment on artificial intelligence shifts even modestly, the mechanical unwinding of index positions could accelerate any correction dramatically. Three pillars, each one, in Burry's view, structurally unsound. Burry hasn't been shy about which names he's positioning against. Palantir Technologies. He has repeatedly disclosed short positions against Palantir, an AI defense and enterprise software company whose valuation multiple has expanded dramatically as retail investors embrace the AI narrative. Burry's argument, government contract revenue, however impressive, does not justify trading at the multiples Palantir commands. Nvidia, the dominant player in AI compute. Burry has been more nuanced here, acknowledging Nvidia's monopoly on high-end AI chips, while questioning whether the company's forward earnings can grow into a valuation that already assumes near-perfect execution for the next decade. Super Microcomputer, the server company that rode the AI infrastructure wave to extraordinary heights. Burry has flagged accounting concerns and margin sustainability questions, broader AI-themed ETFs and thematic funds, where valuations became detached from underlying fundamentals across baskets of stocks. The pattern in his targets is consistent. Companies where the narrative has outrun the numbers, where retail flow has driven valuations to levels that require flawless execution and continued exponential demand growth. Burry isn't shorting artificial intelligence as a technology, he's shorting the prices people are paying to own it. Every bubble in modern financial history has followed a similar arc. Transformative technology emerges. Early adopters make fortunes. Capital floods in. Valuations expand beyond any reasonable earnings justification. Retail investors arrive last, buying the top. Some catalyst, usually mundane, triggers a repricing. The unwind is faster than the buildup. Railroads in the 1800s, radio in the 1920s, internet in the 1990s, housing in the 2000s. In each case, the underlying technology was real. The internet did change the world. Railroads did transform commerce. The problem was never the technology. The problem was the price. Cisco Systems, at the peak of the dot-com bubble, traded at valuations that assumed it would grow to consume the entire global economy. The internet then grew exactly as predicted. Cisco stock still fell roughly 90% and did not recover its peak for over 2 decades. That is Burry's warning about AI. The technology may deliver everything its proponents claim. And the stocks representing that technology can still collapse spectacularly if the entry price is wrong. For investors, the implication is uncomfortable. You can be right about the future and wrong about the trade. You can own the winners and still lose money. Timing and price matter as much as thesis. Burry's contrarian framework demands that investors ask a simple question. At these valuations, what has to be true for me to make money? And how likely is that outcome, honestly? To be fair, Burry has been early before, and sometimes early is indistinguishable from wrong. He was short the S&P during much of the recent bull market. He exited some positions at losses. His public commentary has occasionally been more dramatic than his actual positioning, which he adjusts frequently based on quarterly filings. There are also legitimate counter-arguments to his AI thesis. Artificial intelligence may genuinely represent a productivity shift larger than the internet, in which case current valuations could be justified. Even conservative. Enterprise adoption may accelerate faster than skeptics believe. The largest technology companies do have the balance sheets to sustain massive capex for years without financial stress. And short positions can bleed capital indefinitely while waiting for a correction that may take years to arrive. Burry himself would acknowledge these risks. His edge has never been certainty. His edge has been asymmetry, finding trades where the downside is limited and the upside is enormous if he's right. For retail investors watching this play out, the lesson isn't necessarily to follow Burry into shorts. Shorting is a professional's game with unlimited downside. The lesson is to think like him. Read the actual numbers, question the consensus narrative, and understand what price you're paying for the future you're buying. Here's my honest take. Michael Burry may be early. He may even be wrong on timing. But the underlying framework, so it's that price matters, that concentration creates fragility, that circular financing eventually unwinds, is not controversial. It's just uncomfortable during a boom. Whether you agree with his positioning or not, understanding his thesis makes you a sharper investor. The best trades often come from taking the consensus seriously, then asking what could break it. Full transparency. At the time of recording, I have no position in the stocks discussed in this video. This is not investment advice. Do your own research. As if you want more breakdowns of the investors and companies shaping frontier technology, subscribe. I publish new video essays every week and daily short breakdowns Monday through Friday. Thanks for watching.